Start with this ridiculous, tedious recession debate. What's your take on it?
I think, John, it's that we have triggered the technical definition of recession, but the analytical definition, which most economists embrace, suggests that we are not yet in a recession, but the risk is high.
Is that where we're going, though, Mohamed, from your perspective?
I think the risk is high. It is not preordained. There are things that can still be done to stop us slipping into recession. But I think the two key questions, John, that we're going to be talking a lot about in the next few months is if we end up in a recession, how shallow or how deep is that recession? And secondly, how sticky is inflation on its way down? And I'm yet to hear any compelling argument that says we know where we're going in terms of growth and we know where we're going in terms of inflation. I think there's a lot of uncertainty ahead.
Well, you know what the consensus is. The consensus view is inflation's going to come down, Mohamed, based on what we've seen through commodities. And the consensus is if we get a downturn, it will be shallow, it will be short. What are the risks around that view?
So first, I think the consensus is headline inflation is going to come down, and I agree with that. But core inflation is a different issue. I think we will find that core inflation is going to be much stickier than what we see on the headline inflation. On the recession view, I think Rich Miller of Bloomberg had a really good article a couple of weeks ago saying, how did we get to that conclusion that recession will, by definition, be shallow? We don't know, John. We are in uncharted territory. Let's hope we don't get into a recession, but if we do, it's not clear to me what that recession is going to end up looking like.
Mohamed, in the meantime, you know how this market's been trading off the back of it. Bad news is good news. This was Jonathan Gulliver, Credit Suisse. He said this: whether or not we're in a recession will be debated by academics. The GDP report unequivocally reflects a substantial weakening in economic activity. He went on to say, raising the likelihood of a dovish pivot by the Fed. For now, bad news represents good news for stocks. Mohamed, what do you make of a month that has been pretty weak on the economic side and pretty strong on the market side?
So it's a reminder that there are three influences on markets at the macro level, and the economy is just one of them. You know, you have fundamentals, and if you were to just focus on the fundamentals, then you wouldn't be able to reconcile a pretty terrible month for the global economy versus a really good month for markets across the board. But remember, the market is not the economy. There are two other things that played in. One, it's technicals. There was lots of cash on the sideline. The risk conditioning is good at this stage. You had a good foundation for people to buy, and you have a lot of liquidity. And then there's the relative valuation argument that kicked in as well. So we get these episodes where the second and third determinants of asset prices overwhelms completely the first one. It often happens, John. Over the longer term, however, you need all three to be aligned.
Michael Hartnett came out this morning over at Bank of America, Mohamed, and said it's too early to price the Fed pivot. He's saying sell the S&P at 4,200. Is it too early to price this Fed pivot, given everything that we don't know and that you just explained in the last 3 minutes?
So there's two reasons to price the Fed pivot, both of which are weak. The first are weak in terms of if you want to translate it into it's good for risk assets. The one is that we're going to have a very deep recession and the Fed is going to have to stop. Well, if you're worried about a very deep recession and the Fed is going to have to stop, then you shouldn't be buying risk assets here. Just wait. You'll get better valuations. The second argument is that Chair Powell, in his unscripted remark, said we are at neutral. Now, if you believe we are at neutral, then the scope for soft landing the economy goes up significantly. And then that's the reason why you would get the pivot. So you have to decide why is it that you believe you're going to get the pivot. And if it's the second reason, you've got to be clear in your mind that we are neutral. My own instinct, John, as you know, is that the zip code for neutral is above where we are now.
How much further above?
At least 0.5 percentage points. And as everybody acknowledges, they're going to have to, including Chair Powell, they're going to have to go beyond neutral. So I think the market is looking for a pivot at a time when the only reason you would get it if the economy completely collapses. And if that happens, equities may not be able to withstand that. So I think all these, it just shows you how much uncertainty. And let's not forget what you pointed out, is that we have so much that's going to happen between now and September that even the Fed itself, I suspect, doesn't know what it's going to do in September.